Good morning and welcome to the last in this Imap webinar series on building a client base for wholesale, high net worth and not-for-profit clients. On Monday, we dealt with wholesale and high net worth clients. Wednesday, we had a really interesting presentation on charities and not-for-profits and the challenges of building client bases servicing that market. But today, we're going to draw it together in a strategy approach. How do you build a business for which those types of clients, non-personal clients, non-retail clients, are really central to the target markets for the business? In a moment, I'll introduce Greg Miller, the moderator for this week's series, and he'll introduce our two presenters. But before I hand over to Greg, let me just say a few words about the Advisor Roadshow that IMAP's holding in May, Brisbane, Melbourne and Sydney. On the screen, you'll see a number of the topics that we'll be presenting. And as with all of our Advisor Roadshows, and in fact this webinar series, a key driver for us is making many of the presenters practitioners, those who have active current experience in the issues around building, managing, thinking about advice businesses. It would be a pleasure for me to have you join us at the roadshow, we look forward to seeing you there. I also wanted to mention very briefly the Imap Awards. There's a month left to go for you to enter your portfolios into the Imap Awards. Australian equities, small caps, international equities, multi-sector, fixed interest, also innovation, and the Licensees Award. This will be the fourth year we've run the awards, and in them we try to give exposure to best practice in the operation of managed accounts. If you have a question during today's webinar, at the bottom of your screen, you'll see the Q&A button. Type that in. Greg will field those and manage them as we go. So now it's my pleasure to introduce Greg Miller, the moderator for this series, to introduce our panelists for today. Greg, over to you.
Thank you, Tony, and welcome everybody. Looking forward to this session. We've had two very good sessions this week, and no doubt this one will be equally good or maybe even better. Some great presenters with us today. So we have John Barton with us from MGD Wealth and John Woodley from Fitzpatricks Group, both well experienced in the high net worth market, and so we're going to be looking to tease out as much information we can from these gentlemen as we go through this particular session. So first of all, John Barton, I might go to you. Can you tell us a little bit about this, your firm, the sort of high net worth clients you look after, and what are the key things that you bring to your high net worth clients?
Certainly, Greg. Thanks very much for the opportunity. Look, our firm's about 40 years old. We're about 70 people. We have two offices, one in Brisbane, one in Sydney, although our primary office is here in Brisbane. We've got a multidisciplinary practice. We run a business services tax advisory group, a self-managed super specialist team, a wealth management practice, a risk and succession practice, and a ultra high net worth sort of investment governance and family enterprise governance practice. For many of our clients, they deal with one or two of those practices. And also a significant number, they deal with the majority, or in some cases even all of those practices at various times, depending upon their particular needs. In terms of numbers, high net worth clients are a relatively small proportion of our total. I mean, our mainstream business is retail wealth management and business services work. But obviously by dollar and by asset base, those high net worth clients we work with make up a pretty significant part of our professional practice. I suppose what we think we bring to that audience is a bit of size and scale, but equally a bit of boutique and personal touch. So we think a firm like ours sits in a good space of being small enough to care about every single one of those clients and give them a really personal approach with very senior people. And yet we're big enough that our clients realise that they're not dependent upon just one or two of our people. They've actually got a team of professionals supporting them across their various needs. And then I think the other thing we do is, a number of our directors, and in fact, I suppose the firm overall, having been around for a while and having a reasonably good reputation, I think we offer them a pathway to trust, which is obviously a vital element for all clients, but for high net worths in particular. Right.
Thanks, John. John Woodley, your clients?
Yeah, look, Fitzpatricks, I guess, as a group grew out of the advice practice of Scott Fitzpatricks and myself some 20 odd years ago, where we sort of changed our practice to just specifically deal in the high net wealth space. And I guess Fitzpatricks grew from there with other advisors just asking for advice as how you actually created your business and how you were actually servicing that space. So we've grown over that particular time from working with other advisors and helping them transition or build their business from maybe more traditional financial advice into the high net wealth space. It has a support mechanism. You happen to have a license if people need that, or other services. But the main thing we are doing is helping those people have the skills, I guess, some frameworks to actually work well with the high net wealth space, right up until when they've sort of got to the space of where there really are multifamily offices, to the extent where they're dealing with family constitutions, family governance, a separation of, say, business issues to family issues, helping articulate missions and things like that for families. But it's a process, and helping people, I guess, reorientate their business to that space. And also, when you're in that space, helping bring a whole lot of competencies and capability to actually servicing I guess, because the depth and breadth of the mandate in that world is a little bit different.
Yeah. So John, while you're going, what do you see are the different needs that your ultra high net worth clients need from many of your other clients? Like, what do they ask for? What do they talk about? What do you find is going on in their life that means that your practice has to be different?
Well, I think if we go from the session on Monday, where you are, if you're taking a role in that space, because I think the thing I sort of understand about that space is, as you go further up the scale, the breadth of the issues and the complexity of the issues really expands. It almost compounds. And so, because you've got, sometimes multi-generational issues, you've got multi-asset or balance sheet style issues, you're dealing with those, and the depth that you've got to go to sort of really expands. So the number and the collection of issues just really does multiply. So, and in that space, that large space, they are, especially the emerging family office. So if you go right up to the end of the scale where you have a one office, private office, none of those are the same. And they've really got all the in-house capability. But for the families that are actually, and there's a lot of that now, the emerging wealth, so the people who are emerging into a family office, they haven't got that well-established language around governance, the separation of business from family, what is the mission, or what are the values we want to pass on through the generations. Their assets are values, their assets are the things and the learnings and the principles they want to pass, just not the assets through generations. It's how to protect assets from the family members, but also from, so it sustains. Things like, also a lot of the times their investment time frame, can be huge. It can be 50 to 80 years is their investment time frame. So the way that the types of assets and the types of things that you're actually working with are very different to where, I guess, the sector traditionally came from, which is really around super and fairly straightforward mandates.
Yeah, and I will come back and we'll have a bit of a chat about your investment, what you bring from an investment capability point of view a little bit later on. So, John Barton, from your point of view, what do you see that your high net worth clients need?
Look, nothing completely different to what John's expressed there. I think it is absolutely about complexity, and they do multiply without doubt. Because you're dealing with multiple generations, you're dealing with multiple entities, you're often dealing with a trading business as well as an investment corpus. And plenty of clients who are transitioning out of an active business into an investment corpus, which tends to be more of our sort of clientele. They tend not to be third, fourth generation, they tend to be first or second generation. there is some real issues of totally different process in a trading business than in a much more passive investment corpus, and helping people through that, understanding the different risk profiles, helping people, like you do with all clients, understand why, what their goals and objectives are. That's just much more complex with these clients because they do have more complexity. I think they also find it harder to build trusting relationships because many of them have been targeted over the years and not necessarily by people with only good intent. And even within their close personal relationships, trust is a much harder commodity. Most of us think that money fixes all problems. One of the great learnings I've had with dealing with some of these folk is that more is always better than less, let's face it, but it certainly isn't a panacea. And sometimes having a heap of financial resources comes with an awful lot of stress and pressure and the ability to stuff it up. And so I suppose really understanding risk and doing a good job and living up to that generation that went before you or a couple of generations that went before you is actually quite a lot to live up to. And we've all seen high profile people struggle with that. And at the level we deal with, those issues certainly exist as well.
That's great. John Woodley, you mentioned Monday, and on Monday we had a discussion. The two advisors on Monday talked about how they treat their clients, even high net worth, as retail clients. Just came to me then, do you treat some as retail, some as wholesale? Do you use the wholesale way?
Well, I think it's probably better to answer that. I think sometimes we might want to answer those questions from our current paradigm of advice.
Right.
But I think we answer this from maybe come back to the client and the needs of the family or the family group. I think it's much more of it's not a retail wholesale question. It's what is the collection of needs and things and how best to meet them. And, I'll throw to John on this, but, some of the firms I work with now aren't even licensed, and you can really effectively work with these people because a lot of what you're doing in that space with those families, around governance and everything, is not really a licensed activity. And so I'm sure
100% right. 100%.
Have this experience of working with accountants are really in a good place to do that type of work as well. Financial advisors are very well equipped to do it as well. And so I do think when you're servicing these families, you will probably having a combination or of non-AFSL work, some wholesale fulfillment, and you do need retail capability if you're really servicing the whole family and the complexity of needs. And the depth of needs. John, I don't know what your thoughts are.
John, I totally agree. I think that it's really, the wholesale retail thing is simply one dimension. It's an important dimension, but it's only one dimension. A lot of the work we provide for those top end folk has got nothing to do with an AFSL at all. That's absolutely true.
Okay. What's the sort of stuff, what does that look like, John? I mean, I'm sure people out there are saying, well, what do you do into that space?
Well, if you're providing the sort of governance framework, whether it be an investment policy statement, whether it be a family constitution, whether it be simply helping a family understand the possibilities into the structures around succession planning, whether it be simply having a counselling session with the patriarch, as it often is, but whichever one it happens to be, around have you considered these personality dimensions with these stakeholders and versus those, tough conversations around, well, perhaps your son isn't the right one to take on that CEO role. Perhaps you need to, look at having a non-family member being in that role, and all the emotional stuff that comes with those sorts of conversations, nothing to do with an AFSL. I think a really key point about advice to this segment is the technical aspects are clearly vital, but there's an awful lot of value that comes through the counsel that various advisors in this space provide, which is based almost 100% on experience. Having worked with clients like them before, you've seen some of the issues come up and you see how things play out. And often it's explaining some bad scenarios you're familiar with to a client helps them understand, maybe I need to take some action to get a better outcome. So some of that stuff is just very hard to get from a technical qualification, and some of it is simply, I've seen some clients like this before and I'm familiar with the situation, and that experience is really a lot of times what they're paying for.
Yeah, that's great. You've both sort of used words like governance, separation of duties. I'm intrigued to understand, well, what does that really mean in sort of practicalities? What do you do there? John Barton, do you want to go first?
Well, yeah, look, it's very similar to what we all do in our own professional practices, I suspect. You know, we have written processes and written policies, and we have different people in our firms doing different tasks. You know, simply how do you authorise bank transactions? Well, in a business, whether it's a financial services business or any other business, you're going to have a certain amount of separation of duties once you get to some reasonable level of scale and sophistication, and you do that for all sorts of sensible reasons, to protect the business, to protect the individuals. When families get to a reasonable level of wealth, it's fair and reasonable, and in fact highly desirable that they do adopt some of the same practices. But of course, if they're growing up through that wealth profile, they haven't got them. So it's simply, I say simply somewhat flippantly, helping them identify what some of those risks and issues are, what some of the benefits of making some of these changes are. And look, don't get me wrong, plenty of them go, no, we'll be fine. It's 1 in 5, 1 in 10, 1 in 4, I don't know what the number is, but of a family that goes, actually, yeah, you've got us at the right time. We do want to make these things better. We are up for that conversation, because it takes quite a bit of work from them as well as from us.
Yeah, I bet. John Woodley?
Yeah, look, I think you get a lot more variation in how the families or the people approached it. That, for example, you'd have one of your clients whose wealth has come out of a transaction of selling an operating business, which is the emerging wealth now, and there's a lot of that coming through, but they don't have the language. You know, we would think that because they've operated a business and they've taken their risk on, that they'd have this, you know, huge risk appetite. But when they get with this sum of money, it's like sometimes they don't have the language, or they don't, you know, have the context. Well, I've got this sum of my job's to keep it. They don't actually understand all the different risks, and it giving them a language around that and what they want to do with it and things like that, because they just haven't thought about it. So taking them on a bit of a journey to actually help them, you know, in the middle, and a lot of them do want to have the language around, well, how do I have a values-based, you know, way of being with my family? Because it is about, now it becomes about legacy, it's about protecting it. In their businesses, they wouldn't have thought they were taking much risk on, because they were acutely aware of all of those business risks, and that's what made them successful in that specific area. But now that balance sheet's exposed to a whole variety of other risks that they don't have a language or a knowledge about. And so they do start off a lot of the times quite conservative. And then it's just, you know, and that's one example, but it's a variation all the time.
Well, John, often there's two types. There's the type that are very conservative because they've got this massive nest egg, and there's the type that wants to continue to get the sort of return they got in their active trading days. And you go, well, maybe that's not, maybe that's not the model.
Yeah.
The margins may not be quite the same.
Yeah. If you want compounding 20, 30, 40%, maybe that's not going to happen from a well-governed investment portfolio.
And I think sorry, Greg.
Go, John.
And I think that governance piece that John was speaking about is quite often overlooked. You know, there's another example the other day, significant amount of wealth to be looked after by the generation that earn it. Now they're looking down to the next generation, but there's this pot of money. Now they want to look after and they want to manage it, which is fantastic. What they really wanted a lot of hand with was actually drafting an investment mandate across the whole family group, across the entities, and then for the particular entities and bench, you know, and when they were allocating money out as a family to different people, well, what's this sum of money got to achieve? But writing that mandate, and his thing was, I want to write that to give me guidance and constraints around what I do. Plus, when it goes to the next generation, should something happen, there's already some governance in place for that to go with it. And it's a significant amount of work.
You've brought up investments. Now might be a good time. I'm interested to know, and maybe John Barton, you go first on this, is, you know, what are the investment capabilities that you find you need to bring to, you know, your ultra high net worths, and what do they want to talk about? And then how does that sort of build into this sort of governance approach that you've both spoken of?
Look, I think this is an area where different firms bring a different lens. Our sort of approach for these type of clients in particular is much more about investment governance than it is around investing. So we spend a lot more time talking about investment policy statements, objectives of portfolios, being risk aware, and asset allocation than we do about underlying investments. Similar to a typical retail practice that will deploy third-party managers to actually have specific roles within a mandate or within a broader portfolio. For these sort of clients, you can often get those managers to come in directly and to present to them and to talk about what they're doing within a portfolio. And in fact, you can often, sometimes you can even get bespoke pricing based upon the portfolio. So in a way, it's very similar to a retail client in that our role is to be that someone who coordinates all the investment research and coordinates the managers and helps select underlying managers to actually do an investment management role. Help keep them honest, help put in place an investment committee to actually oversee that specifically, subject to scale for the client. So for us, we specifically don't hold ourselves out as investment experts, although relative to a lot of our clients, we are. It's much more about governance and understanding the function and the purpose. And in fact, very similar to a typical retail client, building a portfolio from the ground up and from the top down.
John Woodley?
Yeah, I think there's that investment piece probably happens at multiple levels to get good fulfillment. The first level is you are talking to a lot of these people about how their whole balance sheet sort of works together. So inevitably you're bringing a whole lot of other assets to the bin. So that standard pie chart asset allocation doesn't quite work in its fullness. It's more like you've got a lot of property, real assets, and they want it, and because they're able, because of the longevity of their period of time frame, the wealth of the money and things like that, you're bringing other assets, like they can afford a lot of illiquidity, and they can take on the advantages of illiquidity. So you've got private assets coming in, private equity, you've got all of these other areas that doesn't quite neatly fit in the other environment. So you've got to bring capability at that level and the discussion of how they should think about that whole mix. And then you've got implementation at the various levels, as John spoke about. But I don't think there's much more to add there. But I do think a lot of them take a bit more of an endowment philosophy to their money, which is bringing in those other asset classes. It's longer term. It's here for a long period of time. It's more around the cash flows that it throws off rather than accessing the capital.
John, I think that's a really, really good point about thanks, Greg, about the pie chart. It's completely, you're right, it doesn't neatly work. And they've got the luxury of being able to think about having multiple portfolios that have quite different objectives. Now, that's a philosophy we bring basically to all of our retail clients as well, but it's just much simpler, and it's a luxury that you can actually think about your family's wealth in a series of buckets, and each one of those buckets can have quite a different set of objectives and very different investments, including at one end of the spectrum, continuing active trading businesses, private equity, which might have a very long duration, or it might be very illiquid and or both. Obviously, liquidity and cash flow is kind of where everything starts, because everyone has a lifestyle expectation. And there's nothing brings up family tension quicker than some of those short-term cash flow expectations not being met. So that's one of the issues you talk about at a family governance level. What's everyone's fair and reasonable expectations? So I think all of those matters are really important to get right and to talk about openly.
Right. In your balance sheet approach, does that mean that sometimes that you're really talking about some more specialist investments and how you complement the rest of their portfolio? Because as you said, John Woodley, I mean, a lot of these people would have made a lot of money over time, maybe in commercial property and so on. And you can't really say to them that, you don't know what you're doing, because they've generated a lot of money doing that, right? And so it's more about the fact that they've got it all in a business and commercial property, and how do they balance that out across other investments?
Yeah, look, I think it's a similar discussion that an advisor would have in a retail space, and it's just bringing in, it's just the depth of it, and it is risk-based. If you think about it here, what's really, the families articulate really what their objectives are for the family, the values, and bringing that right back down. Then really the discussion is based around, well, what's the risk that could come in not achieving that? Then you're having a look at those assets and you're sort of going, well, what if this happened to this specific asset class? If these specific risks came out, what would that mean to those objectives? So it's a very similar conversation, except it's just applying the same principle, but it's the same principles to, their business. Well, what are the risks inside your business? Have you got true succession? Is the structures right? What are all, it's just a bigger list of risks. And you're just saying, do you want to mitigate it? Do you want to keep it? Do you want to insure it? What do you want to do with this risk? And I think the other difference too is your traditional client from where we sort of came from is at this level, you're sort of they're making the decisions, you're asking the questions, whereas I think the retail legislator more is reliant on these people maybe don't have all of the capability and all of the resources to get great advice. So we've got to do a lot more telling. At this higher net wealth space, it's more questioning. You're more questioning, and they're doing the thinking, and they're very much making that, or they're more active in the choice, right up to the single family office, which is they're making the choice and they're just telling you what to do, right? So you've got this variation, but in this we're helping articulate these things. I think one of the key skills that's different is the quality of your questions.
Yeah. Do you both bring specialised investment capabilities into this sort of market? Do you have that inside your firms, or availability to bring to market?
It depends how you define it. I mean, we've definitely got some investment capability, but again, I would say it's more about research and governance and fit for purpose. A key point I think here is to be understand the difference that even within these types of clients, there is a spectrum. There are lower end ultra high net worth clients, and there are higher end ultra high net worth clients. Yep. As you go higher up the spectrum, you tend to be less and less involved, in our experience anyway, you tend to be less and less experienced with investing at all. And in fact, there may well be other firms and other brands who come to an investment committee and who have a function in a portfolio or a part of a portfolio. And in fact, our role is purely governance, and we're not making any investment recommendations. We're not directly engaging any managers. We're simply overseeing. In fact, in some cases, there might be, a family might have two existing investment advisors, and they're administering a portfolio, whether it be a diversified portfolio or a typical Aussie equities portfolio, whatever it might be. We come in at a governance level, and those relationships might remain, they might be tweaked. If we take a role sitting on the investment committee, for example, we're very clear that there's an above the line and a below the line job. And if we're technically above the line with the client, we actually don't do any of the below the line implementation at all. Our value to that client is purely there, providing governance expertise and process and structure, and helping them keep other advisors honest and on track and holding their feet to the fire. It's not around, replacing them or getting, our APL in the process. It's not about that at all.
Yeah, excellent. Thanks, John.
Yeah, that's it. Yeah, I think that's really well articulated, John. And what I like, another story, one of the advisors who was moving into this space sort of rings up and said, "Hey, John, this wealthy family's already got a financial planner in place. What do I do about that?" And my question back, well, why don't you leave them there? Because that then really gets real clarity on your role about, being across that, being more like the fractional CFO with the client here, and actually helping bring these resources to the client. And maybe that current financial advisor that's already in place, maybe what needs to be happening is that we get a clearer mandate for them.
Totally agree. Totally agree.
So, and it's about when you've got these multiple issues, I think you can't cover, very hard for one firm to cover everything. And so it's the quality of your relationships that you bring, the client is really buying a lot of the time, the quality of your relationships and your connections to actually bring to them, to actually help solve the multiple of needs. because of the complexity, I do think part of your business strategy is about simplification. You know, what is really my role? Let's get really clear on the expectation of that role and keeping that really nice and simple. You might have multiple engagements within the firm, or there are multiple engagements through your network of people you help get this result. But I do think simplification and clarity around those things is a really valuable skill set. And I don't think you can get across all the issues in one firm, but I do think it is very valuable to the client that you can actually bring that network to them in a coordinated and well managed way.
Greg, a really important sub point there is that trusted relationships are hard to find for these families. So if you have a competent advisor in place who's doing a good job, and there is still work that is not being done, and you can do that, why would you ever, even if you can technically do the job that other advisor is providing, whether it's investment advice, whether it's tax advice, whatever it might be, if it's a trusted relationship, absolutely leave it there. By the way, if you try to take it out, you probably will be the one who comes off second best anyway, because they have years of trust in the bank that you don't. But if they're doing a good job and it is a trusted relationship, you'd be mad to try to move it because it's a trusted relationship. I mean, if you have good reason to think they're actually not doing a good job, of course you professionally need to speak up. You'll probably still lose that battle, but you still need to do the right thing.
And do you both charge separately for the jobs you do? So if you're doing a governance job, you're charging for that, or if you're doing your investment component, you charge for
absolutely,
that?
Yes.
That's the way you break it up and do that?
With that, I think it's one of the, that skills, and actually I call it engagement skills, of really articulating what's been done in this role, because where we can mix things up, especially coming from that more of that retail environment, is not really understanding what your engagement is. We mix up an engagement that could be just to play a role, like I'm your fractional CFO, and I'm going to help you do things, to I'm your financial advisor, I'm going to be recommending product, to, you know, I'm going to deliver all of these things for you in a year, or I'm going to give you advice once a year. They're all different engagements, and I think that getting really clear on what the engagement for this sum of money is. And I think the other thing I really point out around strategy in that, you should, you know, charge for where the highest value is. And historically, we've sort of maybe, you know, reviewed a portfolio and given away that real value of talking about goals. If the highest value of what you do is around really helping them to get clear on their goals and well organised, charge for that very separately, and charge, because that's where, and then they will value that, and your conversations around those things become richer.
And a few things coming in. So a lot of complexities here. So do you find this is, you can bring some scale to this, or is this just a bespoke market that, your experience is the same, but how you apply it is different?
John, I can have a go. Look, as I said, I think part of your business strategy is like where you sort of see in the traditional retail advice. I think your business strategy there is sort of really summarised by, and even more so now, is let's find more clients, do more than for less money. And you can see that pressure there. It's more of a scale sort of business. As you go up into the higher net worth space, it becomes more of a let's find less clients, do more for them, and you need to charge more to be able to deliver the value. And hence, in your business strategy, you have to reduce something or get really clearer. And what I liked on Wednesday's session, those guys, I think it was Alex and Greg, it might have been, they really understand who they were speaking to. They really understood their market. They could go deeper in their market. They really could identify who that was. So they're really reducing who they're speaking to. And I think really understanding who you're speaking to, and all reducing the scope of what you do or things like that is really quite important, because you can't do everything. And in this market, there's, as John was alluding to, there's just so many different variations of even family offices, even multifamily, even when you go for not-profits, the variation in that market. There's donor side as well, so there's lots of needs there, and we can't satisfy all of those needs. So being really clear on which ones our business can serve best is, I think, is really important.
Greg, I think there's clearly some things you can scale, and I think you need a level of scale to be able to have the credibility to tackle this market. But each engagement is absolutely bespoke. They sound contradictory, but they're both true. A thought bubble I had in my mind about the previous conversation, just to close it out, so I stopped thinking about it, is that I think that's the single biggest difference between the mass market, even the high end of the mass market, what we traditionally call the retail clients, is that in most cases, most of us are GPs for those clients. The clients we're talking about here, they still have a small need for someone with a broad range of expertise, and sometimes we can fill that, but they don't need a GP. They need a number of specialists all doing particular tasks. And John's point around ensuring that each one of those engagements is clear is good for everyone, and is absolutely vital to get that right. And that leads into the scale. Well, you can only do so much. You're better off having, we only have a relatively small number of these clients, particularly at the higher end of these sorts of clients. But by definition, you end up doing more and more for them because you're a trusted source. Trust is hard to find. If you can credibly do a role, they would rather you do it than find someone else to do it often. So building an advice panel, we have a range of external people we work with regularly with these sorts of clients, because again, we need trusted people to help with particular aspects. Even if it only comes up for every 5th client 3 times a decade, you need to have a trusted group of people you can go to and be very clear on what each one of those engagements is and charge for it.
The magic question to both of you is, where do you find all these great ultra high net worth clients? Are they just running wild in Brisbane up there, are they, John?
No, not at all. Very, very long engagement times. If you're coming in cold or relatively cold, it's very hard to come in with these sorts of clients completely cold, of course. It's always referral one way or another, either from an existing client or from another advice partner and another professional who's already got a relationship with them, who knows and trusts you for some other reason. But even then, often years, at least a year or 2 in terms of sounding out. You might get a small job early on, but you very rarely get, an all-encompassing job unless the timing's absolutely perfect and you get on like a house on fire, which does happen occasionally, I suppose. But it's a long lead time, and it's a really good source of referral partners who know and trust you, and a really good set of clients who know and trust you and are happy to recommend them to their colleagues, because these sorts of clients obviously do hang out together. They do know each other, and if you find one, you might have the chance at finding a few over time.
Yeah, I think it's through relationships. So if you just sort of go with what John was really talking about and really well articulated, it is a transfer of trust, and transfer of trust always happens through a relationship. The first bit I think of that is ensuring that you are referable, that you're set up and, you're doing the right thing by the clients and the people refer it so you can do the work. So being referable to start with, and then having that transfer, it's going to come through a relationship. And building those relationships, and for the people who are at fulfillment, or the people who are part of the team that we bring, we work very closely with them, and they're really having a service offering and working with them in the same way so that you can help them in their business and things like that. I don't mean by fee sharing or anything like that, but sharing knowledge so that you can do this work better and all of those sorts of things is really, really important. And you get more of what you got. So I think when you're transitioning from more of a retail business into this space, some point of that, you've actually got 2 types of business in the one business, which is more of a scale business and more of a boutique margin business. That point's really hard at that point. So, because that theory, you get more of what you've got. So if you've got more of this type of client in your client base, you'll get more of that. And then if you've got more refined and more targeted, you'll get more of those type of clients. And that's about being referable, but it's through relationships.
Yeah. Next point I wanted to go on to was, what are the attributes that you see, amongst yourselves or in the other advisors in your firm that make advisors good in this market? What do you need to be good in this market as an advisor?
You need to be good. I think you need to be good at relationships. So I think John's point there around articulating the value of relationships here, which is important for all clients, obviously. But again, these clients tend to have a higher trust hurdle. So the value of relationships is heightened. So you need people who are great with people. You need people who are great at asking questions. I think John articulated that really well before as well. Again, I think it's true with all clients that we come across as good as at our best questions. That's particularly true with these sorts of clients. They need to feel that you have the experience and the technical skills to identify risks they're not aware of, to ask them questions they haven't thought of, to see issues coming that they haven't seen coming yet. That's where you add value.
John, just on that, but do you see, and do you come across, because you've mentioned like you'll come across where somebody's had an advisor, but the advisor's not asking the right questions because they don't know what to ask as well?
Often, yes, often. And that's not a criticism. They're doing a role usually. Yeah. Often the sort of clients we're talking about, they often don't have anyone doing the role we're proposing to do for them. Right? They have people doing, they've all got an accountant, they've all got someone or multiple people doing investments. They very rarely they've often got a lawyer, either a commercial lawyer, a family and estates lawyer, but they 9 times out of 10 don't have anyone who's really had a governance planning forward-looking conversation with them the way, and I think that's the beauty of, and I think it's why some of these practices have grown out of good financial planning practices, is because financial planning is all around those things. We don't talk about governance with retail clients in the same way, but we do it. We certainly talk about planning and goals and, what do you want to leave as a legacy and all those things. It's actually those skills, but just amplified with more complexity, a higher trust hurdle, and a lot more complexity in terms of entities and number of stakeholders. So if you're dealing with the typical mum and dad client, even if they've got a few $1 million, the stakeholders are mum and dad and maybe a couple of kids. For these sorts of families, the stakeholders are much more significant and much more numerous, and they all have much higher expectations. And that's where one of the complexity dimensions arises.
Yeah. John Woodley?
Yeah, so around the skills and the advice, I think John's spot on the money there. Those human skills, and I think advisors are well placed because they come from engaging with people around that, but actually understanding and actually valuing that as a high level capability that advisors can actually bring to this role, and actually, but not thinking that it's a gift or a talent that you're born with. They are skills that can be learned, that questioning skills, those human skills. And you think about the high part of these engagements are relationships. So actually practicing and learning more of those human skills and things like that, and actually bringing it in is a really important part. I see that that's probably underdone a little bit. And actually, what's a good questioning framework? How do you run the client? Really listen well and things like that. So that's underdone. Yeah, understanding scope and engagement are some skills, and they all can be learned. But also hanging out with other people who are working in this space. You can't. That community and that sharing of ideas around this, I just don't think you can underestimate the value of doing it together with other people. And there's lots of people who, maybe not know ultra high net worth space, but the ones just are emerging into it and just below that, they need the application of these skills. And there's a huge need. And there's lots of people needing that. And so for advisors really moving into that, but having their engagement based around that rather than more of the product or portfolio review, but have your engagement specifically around helping people get really well organised and helping them have a safe space to articulate what's important for the whole family group is really important.
Right, that's terrific. Well, look, we're nearly out of time, but I'm going to really quickly and just get you to be succinct about it. But in this market for each of your business, what's the biggest issue or concern that you have in this market each and every week from your firm operating there?
That's a good question without notice, Greg. I don't know if it's the biggest issue, but I think privacy, security is certainly a thing I have top of mind. Cybersecurity is a real issue in our world. And these clients are being targeted all the time, as all of our firms are being targeted all of the time. And I think collectively, I'm personally convinced collectively we don't spend enough time and attention thinking about those particular risks, although it's something we've spent a lot of time on in the last year or two in our firm. But just privacy generally. I mean, these clients by their nature seek, demand, expect and deserve privacy. And I think it can be tempting for advisors on the periphery of this market to name drop occasionally, or for junior staff to think, particularly if you've got people who are not just wealthy, but maybe also have a bit of profile. Those two things often go together. That's something we continually drum into our people, that all the obvious things around privacy.
John Barton, that's a great point. That's what you've raised there is great. John Woodley, point from you.
Yeah, I reiterate, and just to expand on what John was saying about cyber security, even in this multifamily office space, it's really developing almost into a service offering too. It's that big a concern for these families, is that, well, on their own to really run really good cybersecurity is really hard, or have the knowledge for the family. And so that's even a service offering to some of these multifamily offices that are coming out. So it is a big thing. Well, I think for the advisor, what I see is that the big issue for them is managing scope creep and having confidence around managing scope creep.
Good point.
Yeah, okay. Guys, thank you very much for your time. I really appreciate it. I learnt lots out of today's session. It was really, really good. So thank you for your input. We really appreciate it. So I'm going to hand back to Toby. Thank you, Toby.
Thanks, Greg. Thanks, Toby.
Look, John, Greg, thank you very much for really interesting and insightful analysis of how you have to think about an advice business, particularly in both of your cases, multi-office advice businesses, for whom this part of the market is a significant opportunity. So let me just remind you all that many of the issues around running advice businesses, not specifically in the high net worth space, but just the emergent issues that every advice practice now faces as we go through this complete transformation of advice as a profession. We'll be tackling many of those with many practitioners who are grappling with exactly these issues themselves, and can talk about their experience. For example, in thinking about the business model that's appropriate for an advice business. That's the sort of session that we're looking to share in the Advisor Roadshow. So I hope we see you there. So if you've attended this series, thank you very much. To our presenters, thank you. And to Greg Miller, who has been a major contributor in pulling this together as our moderator for the week. Thank you, Greg. We look forward to seeing you in May and again at our next webinar series, which will be in June. We'll be focusing on issues of asset allocation, particularly as it applies in the licensee portfolio management arena. So thanks very much for joining us today. And we look forward to seeing you again at the next IMAP event. Thanks.